Hey, I'm Jack with Jacked Up Finance, and let's talk about investing in your IRA. So I think for a lot of people, an IRA might be kind of a scary black box, but it really should be a very important kind of item for your investment portfolio. So first off, what is an IRA and what does it mean? So an IRA is just an individual retirement account. The big item with this is it is tax advantaged. So of course the government want to support you in your retirement goals. So it is tax advantaged, and that's kind of the core benefit of this. And it's typically a core part of your retirement portfolio, unsurprisingly. But again, just individual retirement account. So next, let's talk about the types of IRAs. So really, I think I'm going to kind of bracket this in two ways. You've got your traditional and simple, and lastly, you've got your Roth. So when we're thinking about a simple IRA versus a traditional IRA, really the main difference is kind of who creates the account. So for your traditional IRA, it's not offered by employers, and there's no employer contribution. So if I were to just go out and make an IRA account for myself, just not affiliated with any company, it would be a traditional IRA. A simple IRA, it's offered by employers, and employers can make contributions. Now, employers are not required to make contributions. We can talk about that a little bit later, but if they were to make an account and they were to put contributions, it would be a simple IRA. So really, they are pretty similar, especially in their tax advantages, which I'll go through kind of in a brief second here. But really the main difference is if you're going to just do the solo individual, you're going to do a traditional. If you're doing it with an employer, it'll be simple IRA. So now let's talk about the main difference here. With a simple versus a Roth, I'm going to make that kind of the comparison now. Really the main difference is how they are tax advantaged. So if we look at this here, kind of this section here, what it says is your contributions are tax deductible, meaning if I put $100 and I wanted to put it in my simple IRA, I put in $100, there's no taxes on it, $100 go into the account. However, taxes will be due when the money is drawn. So essentially the implicit bet that you're making there, which I don't think is a wise one, is you would rather put in tax-free money now and pay the taxes later, which means you think you'd be paying less taxes later. Not sure I necessarily agree with that, and I think that's why I think the Roth is a lot better. So now let's look at the Roth. So again, simple, tax-free when you put it in, you pay taxes when you get it out. The Roth is unsurprisingly the exact opposite. So Roth IRAs are funded with after-tax dollars in this section right here. So the contributions are not tax deductible. But once you start withdrawing funds, the money you take out is tax-free. So again, that's really the massive difference. Simple IRA, you put in the money tax-free. Roth IRA, you put in an after-tax. But then with the withdrawals, simple IRA, you pay taxes. Roth IRA, you do not pay taxes. So I think the Roth IRA is by far the best. I think the main difference here is when you're picking a simple versus Roth, especially if you're early in your career, what you're betting is the tax that you're paying now will be less than what you pay later in your life. So of course your tax would depend on kind of how much money you're making, but also just the tax rate themselves. So I personally have a Roth. I think taxes will continue to go up. I mean, they've really never gone down except for kind of some of the Trump tax cuts on a few items, but generally speaking, they continue to go up. So I'd rather pay taxes right now because I think the tax rates themselves will increase in the future. But also secondly, my income will increase in the future, and that's also a kind of a portion of the basis for the taxes. So I'd rather pay taxes right now with my lower salary and with the lower tax rate than in the future when I think they'll be much higher. So that's really the core of the Roth versus simple versus traditional. I already kind of skipped through the second slide, but use a Roth. I'm going to say it's really that simple, especially if you're early in your career. Tax rates, I think, will continue to go up. Your income, most certainly, but also hopefully will go up. So I would much rather pay taxes right now than in the future. So next, let's talk about contribution and income limits. So this is an important part of your IRA. This is again kind of talking about which IRA is best for you. So this is actually a great chart. So Roth, it's not tax deductible, the contributions, but the withdrawal, they can be withdrawn at any time. And then traditional is just the flip. They're tax deductible to start, but then you pay taxes when you pull them out. One other kind of thing I didn't talk about is required minimum distributions. There are none with the Roth, whereas with the traditional, you have to start taking out a certain amount out of the portfolio once you're, I guess, above 870 and a half. So now let's talk about contribution and also income limits for your Roth versus your traditional. So for your 401k, this is typically what you're going to have with your company. It's going to be $23,500. If you have a traditional or Roth IRA, again, it's an IRA, not a 401k. A 401k just has, it's got a slightly more succinct kind of items you can invest in, but also just has a much bigger cap. But again, this kind of line item here is most of what you're going to be looking at for your employee contributions is $23,500. One important thing I want to say, your employer contribution, which again I'm going to talk about in a second, is not included in this. So these are only my contributions that I'm making into this and to get the $23,500. So this is mostly what we're going to be seeing. Your limit might be $7,000 if you have a kind of a more traditional. I don't want to say traditional because it's not a traditional IRA, but if you just have an IRA, your limit will be $7,000. Really, the main difference here is you just have a lot more versatility in what you can invest in, whereas the employee contribution for the 401k is much larger, and typically you can kind of just invest in kind of more traditional ETFs. So now let's talk about income limits. So again, I think you should use a Roth, but the big item here is you can only use it to a certain income limit. So specifically, essentially the bracket is $150,000. So you can only use a Roth if you're making under $150,000. So you definitely can't use it for forever. So I definitely think you should use it while you can, and definitely try to get kind of as much in there as you can get with it. So ideally you would put in all $23,500 into this account until you hit until you can't anymore, essentially until you're at the $150,000. I understand that would be very difficult, and for a lot of people with their current status and kind of their expenses, they can't do that. But just know you can only use a Roth until until $150,000 of income. So once you hit that amount, you can't use it anymore. So definitely use it while you can. So now let's talk about the employee match program. So employee matching, it's definitely a really great benefit a lot of companies have. But essentially what it means is the employer will put in a certain percentage of your, or they will contribute a certain amount into your account. So here are kind of two example formulas, and I'll kind of talk about my experiences. So this one is essentially 50 cents on the dollar for the first 6% of pay. So what this means is you essentially get 3%. So let's say I put 6% of my paycheck into my IRA. The employer would put in 3%. So again, essentially half per dollar for the first 6%. So that gets you to 3%. The next one is $1 per dollar on the first 3% of pay. So that's 1 for 1. And then the second is 0.5 per dollar on the next 2% of pay. So you get 3% off of this part, and then you get 1% off this part. So in total, this is 4%. Some employers do it differently. Again, so from my experiences, my first employer, they did 1 for 1 for the first 6%. That means if I put in 6% into my IRA, they would match that 6%. My second employer is more of this kind of multi-tier. So they match 1 for 1 for the first 3%, and then half for the next 3%. So that gets me to 4.5%. So again, 1 for 1 for the first 3%, so it gets me 3%. And then for the next 3%, I get half. So that gets me to 4.5%. So I make that 6% contribution on my side, and they make 4.5%. I think in life, there's no such thing as free money, but I would say in your IRA, you 100% need to invest up into the top of your employer match. Otherwise, you're essentially just walking away from free money. So in this case, if I was at this company, I would put in at least 5%. Because I want this 3%, I want this 2%, so I need to put in 5%. For this company, I would put in 6%. So again, you want to take as much advantage of that match as possible. Excuse me. So lastly, as far as how you invest your portfolio, don't get too cute with it. Let's just look at the S&P 500 over the last 5 years. Started at about 3350, and now it's at 6200, so it's really almost doubled. Now let's look at the NASDAQ. So again, it was at essentially 11,000, now it's at 20,000, essentially doubled. So do not get too cute with your investments in your IRA. This is supposed to be your nest egg for when you retire at 60 or 70. So while I like to invest a lot of my assets very risky, I do that knowing I have a good nest egg. My investments for my IRA are pretty much just in the S&P 500 and the NASDAQ, and I think a little bit in the world market, but that's it. I'm trying to keep it as simple as possible. Like I want my IRA with that long time horizon. I want it to be a secure asset for me, so I know I can kind of invest the rest of my portfolio the way I want to invest it, and have pretty high risk there. So that's pretty much it. Again, let's take it from the top: traditional versus simple versus Roth IRA. So your simple IRA is pretty much offered by the employers, whereas your traditional is typically if you want to do one as an individual. That's really the main difference there. As far as simple and traditional versus Roth, really the main difference is the tax benefits. So again, the contribution for the traditional is tax deductible. For the Roth, it's not tax deductible. But then with the withdrawals, the Roth is tax deductible. So with the Roth, again, use a Roth, and this is the answer very simply. So for your Roth, you will get taxed as you put the assets in, as you put the investments in, but the contributions are not taxed, and that's a huge benefit. Next, be aware of your contribution limits. It's $23,500 for most everyone for that 401k. If you have an IRA, it'll be $7,000. But again, I would bet most everyone has a 401k. But either way, be aware of it. Look into it. Income limits, $150,000. Pretty cut and clear. If you're below that, you can use the Roth. If you're above it, you can't. If you're married, it increases some as well. Employer matching. Use the entire match. It's that simple. I'm not going to make this complicated. If the employer matches up to 6%, put in 6%. If they match up until 10% for some reason, which I would be extremely surprised about, match up to the 10%. But do not walk away from extra dollars on the table. And lastly, don't get too complex with it. The S&P 500, the NASDAQ, these are pretty basic indices that you all can invest in with pretty low expenses. Invest in it, watch it, see your IRA just grow over time. But again, just don't get too cute with it. Your IRA is supposed to be kind of your bedrock investment, I think. Invest in a good, safe, simple asset and just reap the benefits. So I hope this was helpful. I hope this kind of helped to demystify investing in your IRA for you. Really, it's an incredible asset for you. It's an incredible asset for your retirement. And it's not a black box. It can be kind of fun to look at, fun to invest in. If you have any questions or kind of you think I didn't cover anything in particular, let me know. But I hope this was helpful, and thanks for listening.